Stage 1 of a trader: unconscious incompetence. Crypto hype and the illusion of easy money. What if the market's first gift is a poisoned apple? What the hell if that early, no-sweat glow is exactly how the trap hides its teeth while your equity bleeds red? The rookie dream begins with hype, not skill. Price motion masquerades as opportunity. I watch this loop chew through accounts while the owners swear it is just bad luck. You hear people minted fortunes in crypto. So the mind draws a straight line from clicking buy to buying freedom. Then whir, click orders fire, candles twitch, and that steering wheel you thought you could handle wrenches you off course. You stare at the up-down rhythm and call it a signal. You press. The market smirks. And the equity curve starts whispering a language you don't speak yet. Here's the core thesis in your story. You mistook volatility for edge and your reactions for a plan. Price ticks up. You buy. Price flips down. You sell. Bam, stop loss cuts like a knife. You reverse again. Take another cut. And then comes the rookie stunt. Size up when you feel sure. Sometimes the market tosses a bone and hands back yesterday's damage. Ego purrs, and the pattern looks clever. Then the next rug pull smacks that ego flat and takes a bigger bite, because bigger size multiplies error. The pattern is self-feeding. Hope fires the entry. Fear yanks the exit. Pride reloads the risk. If that cycle sounds familiar, it should. The story you told is exactly that loop, just with different candles, different days, same bruises. That first-time driving analogy fits, but you miss the ugliest detail. There's no instructor, no dual brakes, and the traffic is algorithmic. You are not trading. You are test driving without a license on a racetrack built by faster minds. The way you learn here, hammering buttons and hoping momentum forgives you, isn't learning. It is conditioning. Every accidental win whispers, "No sweat," while every loss screams, "Do more." The brain files both under confidence or war, and the loop tightens. You are operating under unknown unknowns, position sizing by gut, stop, placement by fear, target by greed, and review by hindsight. Meanwhile, the other side is clocked to millisecond rhythms, feeding on the liquidity you provide when you twitch. That mismatch is not personal, it is structural, and it does not care about your hopes. Slice the pattern. 1. Entries because price moved, not because you saw a repeatable advantage with clear invalidation. 2. Flips because pain arrived, not because a defined line was hit. 3. Size increases because you feel certain, not because your distribution improved. 4. Wins and losses counted in raw dollars, not risk units. So the scoreboard lies. 5. Equity sinks while timing and news take the blame, and inputs stay sloppy. None of these steps require knowledge. They only require impulse. The market, indifferent as concrete, simply monetizes your reflexes. You are not early or late. You are unmeasured. Your best day in this stage is the worst teacher. A lucky green streak stamps authority onto bad behavior. That is the poison. Win by chance and you scale sloppiness. Then the whipsaw hits fake out here. Squeeze there. Stop hunts everywhere, and that smug, no sweat, flips to cold sweat. You slash. You chase. You revenge jig. And the red spreads like a spill you keep mopping with gasoline. Bargaining kicks in. Loss aversion begs you to hold losers because it will come back. It is no one of bestoring, and then that round of. And this furs there looked to 5. Recency bias tells you the last candle has a prophecy tucked inside it. Confirmation bias builds a shrine to whatever just happened to work. And the dashboard keeps dimming less capital, more noise, same behavior. That quiet confession cranking size when you feel sure gives the game away. Feeling sure is not a plan. It is adrenaline in a nice suit. If certainty were real, doubling down would be unnecessary. What you are buying is sensation, not probability. The equity line answers with quick spikes up, deeper steps down, a staircase to nowhere. Serial spikes are not a trend. They are noise dressed as progress. That downward slope is not mystery. It is arithmetic, punishing undisciplined variance. And here's the line nobody wants to own. When you say you sometimes win it all back, you also admit the structure is random. A random structure cannot be scaled safely. Scale randomness, and it scales you. Here's the kicker, you do not say out loud, you are not fighting the market. You are shadowboxing your impulses. The market just supplied mirrors. Every flip, every chase, every gut-sized bet teaches your nervous system to crave more of the same. That is why stage 1 drags on, for months. Sometimes close to a full year. The habit loop keeps paying dopamine while the balance dies by 1,000 cuts. Random wins fuel denial. Denial fuels overtrading. Overtrading fuels bigger losses. And bigger losses demand a story to protect the ego. So the bitter reveal lands here. You did not lose because you were unlucky. You lost because you were unconscious. And markets tax unconsciousness at compounding rates. If that is how stage 1 opens, what happens the moment you finally notice the problem and the lights snap on? Does the pain shrink? Or does it just change shape and come for something even more expensive next? You said stage 1 runs for months to almost a full year. And that timeline exposes the math you kept dodging. Time is not neutral. Every click pays a toll. Spreads, fees, and slippage. Apply a quiet tax that turns coin flip impulses into a negative expectation. Even if guesses split 50-50, the house still nibbles on every single turn. That is arithmetic, not attitude. So when you kept hammering orders because activity feels like progress, you were funding a drip fee on confusion, tick by tick. That meter never sleeps. And your balance learns the lesson. Your ego refuses to read. Unconscious incompetence sounds harmless, but your version is juiced by hype. You did not just think trading was easy. You treated crypto wins from strangers as proof that the road was paved. That is the illusion of transfer. You borrowed confidence from someone else's outcome and stapled it onto an untested process. In your story, the trigger is motion, not setup. Price jogs up. You buy. Price flicks down. You sell. That is not strategy. That is a startle reflex. And a reflex cannot be trained on a random reward schedule without warping. One lucky bounce stamps. No sweat on garbage behavior. The next snapback slaps you, and the hand learns to flinch faster. The loop does not teach skill. It teaches speed. And speed without structure just donates liquidity with a smile. Let me compress your loop in plain terms. 1. You watched candles and mistook direction for edge. 2. You flipped the position the second fear arrived. 3. You raised size when the gut buzzed with certainty. 4. You sometimes won back the loss, which crowned the loop with fake validation. 5. The equity curve still drifted lower on the statement. Under a microscope, each step loads the next. Acting after a move means worse prices. Worse, prices push tighter stops to feel safe. Tighter stops get tapped by noise, which triggers more flips, which multiplies fees, which sinks expectation below zero. That is not bad luck. That is a conveyor belt. Now, the ugliest phrase in your paragraph. Chuck N. Feeling sure. Certainty spikes exactly when recent candles line up in one direction. The same alignment that seduces the eye also loads the spring for mean reversion. So your largest positions get placed right before the rug pull. Bang, stop loss cuts like a knife. Slippage salts the wound, and pride rushes in to get it back. Your size distribution becomes anti-edge, small when the tape is choppy, huge when snapback risk is highest. That is why the pain feels personal and brutal. It is not personal. It is mechanical. You built a sizing rule that places your biggest chips on the most fragile ground, and then you called the collapse unfair. Your driving analogy tries to soften it, but reality is sharper. A car does not fake a lane change to run your stop. A market does. A brake pedal does not weaken because a crowd showed up. Liquidity does. A classroom hands you a syllabus before the test. The tape hands you the test first and charges you for every wrong answer. When you admit you did not know what to do with the steering wheel, that is not clumsiness. That is running live speed without a model for invalidation and without a unit for risk. The wheel jerks not because you are unlucky, but because you are reading motion as meaning and writing checks your account cannot cash. Then there is the word that keeps you stuck, sometimes. Sometimes you clawed it back. Sometimes you hit a heater. Sometimes the bounce loved you. That single word anesthetizes months. It keeps you believing the corner is inches away. But the corner moves whenever the plan is feel-based. You do not crash once and learn. You dissolve in a hush of almosts. Each near miss buys another day of denial. The cost is not only money, it is calibration. Your internal compass begins pointing toward whatever just worked. So you scale the wrong behaviors at the worst times and call it growth. The equity curve does not argue. It just slopes. And this is where your passage tees up the next chapter you hinted at. You say, stage 1 ends, and you quickly move to stage 2. Lights on. Right. Except lights do not cure blindness. They expose it. Recognition does not erase reflex. The minute you see the loop fights back. It whispers that more screen time will fix it, that a little more size on the good ones will showcase progress, that next week will be different because you finally get it. That is pride dressing up panic. If the pain of ignorance finally hits daylight, what happens next? Do you actually change the machinery? Or do you repackage the same loop with a cleaner label and swear it is different? You painted stage 1 like chaos that somehow morphs into clarity after a few months, maybe about 1 year, as if pain itself flips the switch. That is the cozy myth baked into your paragraph. Time does not train. Time hardens reflex unless the machinery changes. Tick by tick. You conditioned yourself to chase motion, to measure sure by how loud the pulse gets, to treat a green candle as a green light. The platform sprinkles dopamine with every fill click. Ding, whir, and your brain welds speed to hope. That is not education. That is Pavlov with brokerage fees. Strip your story to gears. First, you entered, because many people made a lot of money in crypto. That is selection bias wearing a party hat. Second, you renamed price swings opportunity and swapped process for activity. Third, you flipped sides whenever discomfort spiked, baptizing avoidance as agility. Fourth, you sized up on that shakin' vibe, a woozy false certainty, right before mean reversion spits in your face. Fifth, you counted outcomes in raw dollars, not in risk units. So, random variance looked like skill when green and like injustice when red. None of those steps require knowledge. They require impulses. The tape simply taxes the impulses. The quiet rot lives in your reference points. You anchored to starting balance. So every dip became a rescue mission. You anchored to the last few candles. So momentum felt inevitable. You anchored to strangers' wins. So your mind outsourced proof. Even the driving analogy turned into an anchor, as if the wheel should obey. Your own lines confess the wheel does not care. You buy and it drops. You sell and it rips. Bam knife. Sting. Rug. Repeat. Anchors are not guidance. They are magnets that bend your compass toward noise. Here is the systemic kink almost nobody names, and you only brush past it. Variable reinforcement. Sometimes you claw it back. Sometimes the flip saves the day. Sometimes the heater lands right after you size up. That sometimes is the drug. A slot machine pays just enough to keep the hand moving. Your loop pays just enough to keep the finger on the trigger. The brain learns craving and speed. It does not learn edge. Stage 1 lingers not only because of ignorance. It lingers because ignorance is intermittently rewarded. Luck fertilizes bad habits and calls it progress. Another fracture hides in plain sight. No explicit invalidation anywhere. Only discomfort. A line that proves the idea wrong never appears. Pain appears, and pain becomes the line. That is why you reverse instead of exit. Reversing looks like action. Exiting would force a verdict. Without invalidation, every trade mutates into 2 trades, sometimes 3, until the original thesis evaporates and only reaction remains. Each flip resets the story, but not the risk. Fees tick. Slippage nibbles. Attention burns. The account foots the bill while the narrative keeps changing costumes. Now, tilt the lens to sizing. You increase size when you feel sure. That is anti-edge. Conviction peaks exactly as extensions stretch thin and snapback risk swells. So, the biggest bet lands at the most fragile point. Bang stop-loss cuts like a knife. The fill slips a little. Pride flares. And the revenge click lands. Your size distribution is inverted, small during chop, huge into exhaustion. The market did not single you out. The rule you smuggled into your process executed you cleanly, and you signed the order. Even your timeline carries a trap. A few months to about 1 year reads like a rite of passage. 2A, toll you pay before wisdom arrives. Calendars do not confer skill. They grind capital while habits ossify. Survivorship bias whispers that sticking it out guarantees a corner turn, and the loop happily nods while the equity line slopes like a tired staircase. You mistake endurance for insight and pin a medal on grind while the meter keeps running. Then you toss the word quickly, as if stage 2 unlocks the instant you admit the mess. Quick according to whom? Recognition does not rewrite conditioning. Seeing the cage does not bend the bars. The same machinery that chased green will chase the next label, the next tweak, the next heroic size on the next no-sweat setup. If stage 1 is unconscious incompetence, the next chapter does not begin because you crave a new name. It begins only when anchors, random reinforcement, pain as stop reflex, and gut-based sizing lose their grip. Until then, the story just rebrands itself, while the arithmetic keeps chewing. So, here is the bitter edge your paragraph dodges, when the naive story stands beside the market's reality. Which voice will you obey, the tale where time cures everything? Or the tape where math wins every argument and emotion keeps paying the bill? Naive thinking says the market is a friendly highway and the wheel will obey if you grip it harder. Harsh reality says the road moves under you. The lane lines are illusions, and every twitch is monetized. In your paragraph, I hope reads the tape like a promise. Price goes up. That means go. Price goes down. That means switch. Sometimes the switch pays. So the reflex looks smart. Reality answers with the bill, spreads, slips, and churn siphon value, even when direction guesses split even. Your story calls this learning. Reality calls it negative expectation dressed in hustle. Naive thinking says activity equals progress. Harsh reality says measurement equals progress. Your version stacks clicks and calls it growth, as if repetition alone can sand down the edges. The tape counts only calibrated decisions. Every unmeasured flip deposits a fee. Every fee lowers the break-even bar. And the edge you do not have must now outrun the toll you cannot see. You bought because it moved, sold because it hurt, and sized because it felt sure. That is not a plan. That is an accelerant. The equity curve did not misunderstand. It performed the math. Naive thinking says more. Size proves confidence. Harsh reality says more size magnifies error. You scaled exactly where the tape loves to snap, so the ugliest cuts landed on the largest positions. Bam, stop loss slices, fill skids, and the blood rushes. Then the chase, then the reflip, and the churn drills deeper. You called it unfair. The process called it predictable. Sizing according to thrill makes the risk curve kink the wrong way, small during noise, huge into exhaustion. A market built to harvest forced flows will not waste an inverted rule like that. Naive thinking says luck that pays validates the method. Harsh reality says random wins are the sugar glaze on poison. That sometimes you worship is the intermittent donation that keeps the hand moving. I hear the cadence in your lines, a green streak, a smug grin, a louder heartbeat, a bigger click, then a sharp reversal, and the whole thing tumbles. The mind edits out the fees and remembers the bounce. The statement does not lie. The slope drifts lower while stories get shinier. Every almost stamps authority on nothing. Naive thinking says pain is proof the idea changed. Harsh reality says pain is not invalidation. It is sensation. You reversed when discomfort got loud, not when a line that would disprove the thesis was violated. Without a defined invalidation, the trade mutates on contact with fear. 1 becomes 2, becomes 3, and the original claim dissolves into motion sickness. The market did not outsmart you. The absence of a boundary did. You were not wrong or right. You were undefined. Naive thinking says time in the chair matures skill. Harsh reality says time under randomness ossifies bias. A few months to about 1 year reads like a right. The loop loves that story. It grows roots while you wait for wisdom to sprout. The conditions inside your paragraph feeling sure, chasing movement, flipping on pain, worshipping sometimes do not fade with the calendar. They deepen. The brain becomes a high-speed translator of noise, fluent in the grammar of impulse, allergic to stillness. Endurance pins a medal on the grind. The tape pins a bill on the account. Naive thinking says the market's motion is a message to you. Harsh reality says the market's motion is a message about everyone. When you buy because it popped, you join the tail of a move many already rode. They have exits. You have hope. When you sell because it dipped, you sold into someone's planned refill. They have structure. You have relief. The gap between those two worlds is not mystical. It is procedural. Structure beats sensation because it can be tested. Sensation beats you because it can be triggered. Naive thinking says stage 1 is a tunnel and daylight waits if you just keep walking. Harsh reality says daylight only appears where measurement replaces story. Your paragraph tiptoes around that line. You hint at a next phase as if recognition flips a switch. Recognition does not rewire conditioning. It merely lights up the mess. And here is the shadow corner your story never names. The minute you glimpse the loop will offer a shinier version of itself, cleaner labels, fresh promises, the same reflex in a nicer suit. If the disguise looks better, do you call it growth and keep bleeding? Or does the contrast finally force a different lens? Part 5 opens where your paragraph finally runs out of excuses and stares at the wreckage. The escape hatch is not a hack. It is a different lens on the same tape you kept misreading. You called price motion a message to you. I call it a census of everyone. You, treated sometimes like a lucky charm. I treat it like a sugar glaze on poison. If stage 1 is unconscious incompetence, then the only door out is built from measurement that starves the slot machine drip. Not a pep talk architecture. Start with the scoreboard you avoided. Dollars seduce. Risk units tell the truth. When you count in dollars, a fat green day looks like skill, and a deeper red day looks like betrayal. When you count in risk units, the tape translates to expectation. A trade either paid more than one risk unit after costs, or it did not. Spreads and slippage are not background noise. They are the toll gate. Once the scoreboard flips from cash to risk, activity equals progress dies quietly, and calibration equals progress takes the wheel. The same candles you chased become test cases, not invitations. Then the line you never had, explicit invalidation. Pain cannot be the line. Pain is volume. Your paragraph shows how discomfort turned exits into reversals. Without a boundary that proves the idea wrong, every trade mutates into a chain of reactions. Flip, reflip, scalp. The scalp and the toll meter sings. A clean boundary does not make the loss feel good. It makes the loss finite and the data clean. You called that steering wheel a mystery. Boundaries make the wheel stop lying. The market still shapeshifts. Your decision tree stops doing it with it. Now the part that sliced you the deepest, conviction-based sizing. Feeling sure right before snapback is the anti-edge. The escape hatch narrows that throttle. Size becomes a function of predefined risk, not of pulse rate. The thrill will still bark. It just does not hold the calculator. When sizing no longer spikes, at the exact moment extensions get fragile, the ugliest losses stop landing on the fattest tickets. The story inside your paragraph changes tone, fewer bang moments, more measured nicks, and the rare bigger win when the structure actually holds. Intermittent reinforcement your beloved sometimes needs a choke point. The loop lives on surprise gifts. Remove the surprise before the click. The trade is already written in a sentence. What the idea is, where it is invalid, what the expected pay is in risk units, and what disqualifies any mid-trade flip. That tiny script kills improvisation, disguised as agility. It also makes boredom show up, which is exactly why Stage 1 hates it. Boredom is not a problem. It is evidence that the dopamine sprinkler got shut off. Your timeline trick, a few months to maybe a year, pretends the calendar handles the wiring. The escape view treats time as sample count. Each trade is a data point, not a mood swing. The question stops being how long until it clicks and becomes what does the distribution say after costs? When you stare at a distribution instead of a highlight reel, that word quickly evaporates. There is nothing quick about replacing reflex with structure. The win is not faster. The win is cleaner. Clean data humbles ego because it refuses to confirm bedtime stories. The driving analogy wants comfort. The tape offers terms. You bought because it rose, sold because it fell, flipped because it hurt. The alternative is blunt, Buy because a defined condition prints. Sell because a defined boundary breaks. And refuse to flip inside the same thesis because pain growled. The market still fakes and squeezes whir, click, rug, but your participation stops being the free snack. The old loop wanted to prove you right. The new lens only wants the math to be readable. There is also a quieter shift your paragraph never touches. Stage 1 chased speed. The escape hatch rewards slowness. Not paralysis, slowness. The breath before the click. The reread of the invalidation line. The gut screaming, now, while the model whispers, when. That pause is not fear. It is the removal of noise from the data you say you want. You still get cut stop-loss slices like a knife. Always will, but the cut is inside a budget defined before the blood. Less drama, more truth. So, picture your own words under this lens. Same chart, same candles, same up-down rhythm you thought meant go. Now, the scoreboard is risk units. The boundary is written. The size is fixed by plan. The mid-trade flip is disqualified unless the boundary fires. And the review measures expectation after the toll. The market does not turn friendly. It just stops renting space in your limbic system. If that is the hatch out of stage 1, then what does stage 2 actually look like when the slot machine glaze is stripped off and the math gets? The mic, does the bite soften? Or does the reality sharpen and finally give you the leverage you kept faking? Stage 2 under your paragraph shadow is not triumph. It is the moment you finally know what you do not know, and the tape stops pretending to be your friend. The slot machine glaze burns off, and the story that claimed a few months to maybe a year and you are out turns inside out. Damn, recognition stings. Because now every flip without invalidation reads like panic on the statement. Every gut-sized bet flashes anti-edge in neon. And every sometimes win looks like bait on a rusted hook. You want it soothing. The ledger offers teeth. Whir. Click. Snap. The fills still land. Only now, the noise no longer masks the bill. Your text hints that progress happens quickly once you see the mess. What the hell is quick? When the reinforcement engine you built hums in your spine. Stage 2 is conscious incompetence wearing a shock collar. You catch yourself mid-reach. You hear the old story whisper, no sweat. And you watch the hand hover anyway. That is not failure. That is the first honest read you have had. The tape did not change. Your lens did. You stop calling motion meaning and start treating it as the census it always was. You stop translating candles into prophecies and start rating them as evidence with cost attached. The same market, a different contract. Synthesis lands here. The market never lied. To you. You lied to yourself about what its motion meant to you. Stage 1 baptized impulse as strategy. Stage 2 audits the impulse and taxes it. The same up-down rhythm now runs through a sieve. Risk units instead of dollars. Invalidation instead of discomfort. Sizing by predefined risk instead of chuckin' thrills. No, mid-trade costume changes, because boredom feels insulting to the ego. Each swap is insultingly simple, which is why stage 1 never used it. Simplicity removes the drama that fed your loop. No drama. No excuse. You tried to negotiate with randomness, and randomness kept your FOF. Terms loose on purpose. The synthesis says you stop negotiating. You price it. You price the spread you kept ignoring. You price the slippage you called bad luck. You price the churn that disguised itself as learning. Arithmetic sat there the whole time like concrete. You just kept throwing slogans at it. Now, the concrete answers the questions. Does the idea pay more than one risk unit after costs across a large enough sample, or does it not? If yes, it stays. If no, it goes. No mysticism. No heroics. Just a ledger that does not care how hard you tried. There is still bite. When the glaze fades, pride starts bargaining. It will pitch you a cleaned-up remake of Stage 1, same reflex. Prettier language. New indicator. Same chase. It will invite you to trust yourself right at the edge of extension and tell you the new line will hold because you finally get it. That is the old drug in a fresh bottle. You will feel the buzz. You will want the bigger size. And then, the snapback will ask the only question that matters. Did the calendar story survive? Or did the arithmetic own the wheel this time? The answer gets written in fills, not feelings. You wrote like, the market is a steering wheel that should obey. Synthesis says, the wheel is a mirror. Grip harder and it only shows you your face. If the face is wired for sometimes, the mirror will pay sometimes and tax you always. If the face is wired for measurement, the mirror will pay when the crowd gifts mispricing, and it will cut when the idea is wrong. And nothing in that sentence needs drama. That is not heroic. It is annoying. It is annoying. Annoying beats ruin. The tape does not award medals for endurance. It rewards clarity and bills confusion. Every single time. So no, Stage 2 does not arrive because you suffered for long enough. It arrives because the arithmetic finally gets a vote louder than the story. The tape never promised happy endings. It promised a ledger. You either learn to read it or you keep decorating it with excuses. I am not here to hand out comfort. I am here to point at the ledger and the gears you described and say, stop pretending the poisoned apple was a pear. The bite was real. The choice is whether you keep licking the sugar or you start counting the teeth. If my words hit like a gut punch, share this with your crew. Subscribe to Flow State Trading so you do not miss the flow. Next, raw breakdown. If the bite left a mark, leave it on someone else's screen and let them feel it too.